The accrual basis accounting. Accounting records are kept on an accrual basis, except the case of very small businesses. To accrue means to collect or accumulate. This means that revenue is recognized when it is earned, regardless of when cash is actually collected, and expense is matched to the revenues, regardless of when cash is paid out. Most revenue is earned when goods or services are delivered. At this time, title to the goods or services is transferred. There is created a legal obligation to pay for such goods or services. Some revenue, such as rental income, is recognized on a time basis and is earned when specified period of time has passed. The accrual concept demands that expenses to be kept in steps with revenue, so that each month sees only that month's expenses applied against the revenue for the month. The necessary matching is brought about through the type of journal entry. In this chapter, we shall discuss the adjusting entry, also as closing entries. Through which the adjusted balances are automated, transferred to balance sheet accounts and at the end of fiscal year. Adjusting entry covering recorded data to adjust expense or income items have already been recorded on a reclassification is required. That is, amount only be transferred from one account to another. The following example will show how adjusting entries are made for the principal types of recorded expenses. Prepaid insurance. Assume that a business paid 1,200 premium on April 1 for 1 year's insurance in advance. This represents an insurance in one asset prepared expense at a decrease in another asset. Thus, the entry would be prepared insurance in cash 1,200, and at the end of April, 1/12 of the 1,100 or 100 have expired. Being used up, therefore adjustment to be made, decrease or crediting prepaid insurance and increase or debiting insurance expense. The entry would be insurance 100 and prepaid insurance. Insurance expense. Thus, 100 will be shown as insurance expense in the income statement for April, and the balance of 1,100 will be shown prepared insurance in the balance sheet. Example 2, prepare rent. Assume that March 1 a business paid 1,500 to cover rent for balance of the year. The amount would have been recorded as a debt prepaid expense in March, since a 10-month period involved. The rent expense is $150. The balance of prepaid rent will be 1,350, and at the beginning of April, the adjusting entry for April will be rent and expense. At the end of April, the balance prepaid will be 1,200. Example 3 is supplies on hand, a type of prepayment. Our supplies were purchased on April 1st. At the end of April, expense and revenue are to be matched statements prepaid. The count of amounts on hand will be made. Assume that inventory shows that 250 of supplies are still on hand. Therefore, then amounts consumed by during April was 150. So the two entries supply expense of 150 will be included in April income statement. Supplies on hand of 250 will be included as an asset on the balance sheet of April 30th. In each of above example, the net effect of adjusting entry is credited, and the same amount was originally debited. The following example of illustrated are called the valuation of offset. Accumulation of depreciation, accumulated. Previous adjusting entries, the balance of the assets mentioned, prepaid insurance, prepaid rent, prepaid supplies are reduced. The assets usually lose their value in a relatively short period of time. However, assets have a longer life expectancy, such as building equipment, are treated differently because the accounting process wants to keep a balance sheet record of balance original historical costs. Adjusting entry needed to reflect the true value of the long-term asset each year must be allocated. Spread the cost of the original price. This spreading concept is known as depreciation, in order to accomplish the objectives of keeping original cost of equipment and also maintaining a rounding total of depreciation allocated. We must create a new account entitled accumulated depreciation. The amount is known as a contra asset, as the opposite of balance of its asset, and it summarizes and accumulates the amounts of depreciation over equipment's total useful life. Assume that machinery costing was purchased on February 1st on the current year and was expected to last 10 years. With a straight line method of accounting equal charge, the depreciation will be 1,500 a year, or to $125 a month. Adjusting entry will be depreciation expense, and accumulated depreciation. Allowance for collectible A business with many accounts receivable will reasonably expect to have some losses of uncollectible accounts. It will be known as specific account will not be collected, but experiences furnishes a statement of the total uncollectible amount. Assume a company that it estimates 1% of sales on account will be uncollectible, then such sales as 10,000 for April is estimated. 100 to be uncollectible. The actual loss may be definitely be determined for a year or more. The loss attribute will be called an adjusted entries. So uncollectible account expense 100, allowances for uncollectible 100. If the balance of account